Hi. Well, thanks for having me down. I'm originally from Buffalo, New York, so I'm very appreciate bringing the weather with you. So very, very polite of you. I thought I'd just spend a few minutes kind of giving a high level of tax reform, the U.S. tax reform. Is I think David said it was a very comprehensive change, one that has been made in the U.S. in the last 30, 31 years. It is very difficult for the U.S. because of our political parties to actually pass meaningful legislation. All the stars have to line up right, and it did. There's a lot of uncertainty. There's a lot of confusion. There's a lot of difficulty with this tax legislation. It was not rushed. This had been going on for a number of years, but because of the magnitude and the breadth of change, the IRS, Treasury, Price Waterhouse, other advisors don't have all the answers, okay? So what I thought we'd do is kind of spend some time going over the key provisions, focusing in on what I thought would be most relevant to you, mostly the international provisions, and just kind of spend through it. We're going to get into a little bit more detail in some of the later sections today on some of the provisions, including what we're calling guilty and the beats provisions and things of that nature. So the headline changes, the reduction of rate.
I have a question for you. Was that a coincidence that it was guilty and beat?
No one actually knows exactly how they came up with those acronyms, but we're all envisioning some person from the IRS going home very excitedly to his wife or husband saying, hey, I created an acronym in the U.S. for the tax code. And it's just a bunch of tax geeks, I think. But the headline rate is a 21% rate, down from 35. Hugely important because America was just not competitive. The provisions in the aggregate will make the Americans more competitive, particularly investing internationally. I saw the slide where you were talking about U.S. being an exporter of capital. While that had been eroding for a whole number of years, in large part because of our tax law. The rates are one thing, and the way that U.S. taxes is another. So 21% rate, kind of harmonized to about the average of OECD and Western Europe. They tried to get it down to 20, couldn't do it with restrictions on the amount of deficit. The aggregate of this bill loses $1.5 trillion over the next 10 years. That's a lot of money. With the big change on thing was the deemed toll charge, okay? We are going to a territorial system, which is the next point. Let me jump down there and I'll come back up to the toll charge. The U.S. has historically not subjected a foreign subsidiary's earnings to U.S. tax until remitted as a dividend. That was under our worldwide system, similar to the one Mexico currently has. It was a very, very complicated system. Very few countries hold on to that kind of taxing system. Most countries have a exemption or what we call a DRD, a dividend received deduction, effectively exempting much of that income as it comes back to the U.S. The U.S. is going to that method, okay? So now when a foreign subsidiary pays a dividend to the U.S., 100% of qualifying foreign source income that is coming to the U.S. will be given a deduction. It is not an exemption. There's a deduction, and that does have a lot of implications when you get into some of the technical weeds. But effectively it means dividends won't be taxed again in the U.S., okay? In order to move to that system, which is very, very expensive, over $1 trillion revenue loss in and of itself, the U.S. is adopting what we're calling the toll charge. I expect that to be one of the provisions that you hear most about and are asked to help mostly if you have a U.S. parent or, you know. So what that effectively is saying is for years and years and years, many companies were not bringing back their foreign earnings from foreign subsidiaries because they were going to have to pay a tax on it. So they left those foreign earnings offshore, reinvested them in local countries, and grew the business. Some just left the cash offshore in a bank account. There's a whole wide range of what U.S. companies did with respect to that. What toll charge is saying is any earnings earned after 1986, which incidentally was the last time we had major tax reform in the U.S., is going to be deemed a dividend in the United States. So, for example, if a Mexican subsidiary of a U.S. company had made earnings and profits, we'll define that later, anytime since 1986 in the aggregate, those earnings are going to be taxed in the United States on 12/31/17. The math here gets hard, okay? There are different measurement dates because people like David and I were doing a lot of planning, so they put in some laws that said it's going to be your earnings and profits as of either November 2nd, which is when the House passed its bill, or the 12/31 date, which is the date of enactment. There's a lot of complexities between interactions of those two dates, not necessarily relevant here. The important part is the U.S. was saying, okay, companies that were not being good corporate citizens were keeping their cash offshore in cash and cash equivalents. We're going to tax that at 15.5% because our deferral that we had granted those U.S. companies was being abused. And it was. A lot of companies you'll see in the newspaper are recording billions in dollars of tax charge because of this provision. In a large part, U.S. companies were keeping cash offshore and borrowing in the U.S. to pay dividends. It was just cheaper that way.
Does this actually mean that the Mexican subsidiaries of U.S. groups will need to provide information for the last 32 years to recalculate the earnings and profits, and then also from a Mexican point of view to do the respective either CUFIN or CUCA, so dividend or capital redemption calculations?
Yeah, right now, the U.S. tax people are very, very busy because all this has to be recorded pursuant to the provisions that are, come out, the financial statements in, normally end of January, sometime February, early March. So the U.S. tax departments are recomputing earnings and profits, basically retained earnings revised for U.S. tax principles back from 1986. And there is a foreign tax credit reduced proportionately by the reduced rate of tax from either 15.5% for cash or 8% if it's not cash. So that foreign tax credits, we need to get the tax returns for the last 31 years. So I would not be surprised if you get an email from that you initially think is a really stupid email that saying, hey, I need tax returns from 1986. Well, it is a stupid email, but that's the reasoning why we needed those information. So that's the
And by
total.
tax returns, you mean Mexican tax returns?
Mexican tax returns and proof of payment. So now this tax is payable over 8 years. It's back-end loaded. Again, it is not an actual cash dividend from Mexico. It is a deemed dividend that is being recorded in the U.S. return. Heads up, though. If there is a deemed dividend, when that dividend and when that cash is moved in the future, it is not again taxable in the U.S. We call that previously taxed income. Since the U.S. has already paid whatever tax they're going to pay, there is not going to be a tax on that in the future. I would expect the Treasury policy of a U.S. MNC with a Mexican subsidiary is going to change, that there's going to be a increased movement in cash from Mexico back to the United States on a more regular basis, now that we've taken the tax limitations off. So.
Okay. I think you already mentioned the thing to the shift to territorial system, but what about the guilty?
Yeah, let's do guilty fast. So the U.S. has not eliminated their subpart F provisions, their deemed repatriations. This is actually one that's going to hit a lot of Mexican companies as well. It basically says that if the Mexican subsidiary of a U.S. company or any subsidiary is earning high margin income, then that's going to be subject to the U.S. immediately, not wait until the monies are repatriated and as a dividend where the U.S. has given this exemption. And the provisions are onerous. If the definition of intangible is kind of a residual. They're saying if you earn, the Mexican subsidiary earns more than 10% of its asset base, so they'll take their assets and multiply it by 10%. And if the income is more than that, there's an implied assumption it's related to intangible income. And they're going to tax that in the U.S. at reduced rates. Right? They're going to give a half deduction for it, 80% foreign tax credit. It comes into probably about a 12.5%, 13.5% rate, somewhere in there depending upon some things. So why don't we go on to the next one and change the page
Okay.
here for a minute. So whereas what we're calling guilty is bad, again, the U.S. is trying to get those intangibles and the income earned in the United States directly. An incentive is the foreign derived intangible income. This tax change was called a Tax Cut and Jobs Act. This is the Jobs Act part. What they're saying is if U.S. companies are earning foreign source income, they're going to get subject to a reduced rate. It's about 13.125%. So if a U.S. company receives royalties, export sales, leases of assets, that income is subject to a potential lower rate. Now, it has to go over a certain threshold, 10% of assets, again, measured at the U.S. level. But if it gets over that, they're saying the intangible income related to that non-U.S. activity is going to be taxed at, 13.125, a very, very low rate, encouraging U.S. jobs, U.S. manufacturing, U.S. exports. Okay?
So then territorial but not territorial.
Hybrid. America first.
Okay.
Base erosion is really directed mostly to inbound companies, although it's not exclusively. Okay? It's not designed that way. It's basically saying if a U.S. company is paying a related party for non-cost goods sold, it's a minimum tax. The U.S. for years has been base eroded, where the U.S. would be paying foreign companies or foreign-related parties and reducing the income tax in the U.S. And that was a very good idea, and supply chains were structured that way because the U.S. was at 35%. It's 21%, so that will naturally probably change. But to the extent it doesn't, this is a minimum tax. So you have to do a with and without calculation. The with calculation would be, what is your normal income tax with some modifications? And then without is exclude the related party payments. So if you're making interest or royalty payments from the U.S. to Mexico, to other parts of the world, then you have to add that back in doing the with and without. The excess of that income is going to get subject to 10% tax with some ability to use some NOLs. It's really a minimum tax. So that's one that's going to inject. But the bigger one is interest expense. For years and years, the U.S. has probably had the most generous financing permitted. We've not had an effective limitation on the amount of interest expense a U.S. company could claim with related or unrelated. We did have a limitation, but it was very rare that companies effectively hit that limitation. That's changed, and it's not just for a related party. This is one of the biggest, what I'll call sleeper provisions that is impacting U.S. companies regardless of whether or not they've got foreign investments or not. The rule now is that you cannot deduct in the U.S. more than 30% of, for the first few years up until 2022, 30% of EBITDA, right? EBIT plus depreciation and amortization added back. After 2022, the rules even get harder, where you can't have 30% or more of EBIT. So you don't even get to add depreciation or amortization back. This is impacting nearly every single one of my clients. What you're going to see, and I wouldn't be surprised if people in this room get impacted by it, the U.S. has got to redo their financing. This is not just related parties. This is external debt as well. What U.S. companies are going to end up doing is trying to push some of this debt down to their foreign operations or back up to their parent, regardless of the structure, U.S. inbound, U.S. outbound, the U.S. cannot suffer now more than 30% of debt. And this is kind of being harmonized mostly with what we're seeing in the OECD. It's right in line with OECD standards. So.
And I guess part of the reason because the U.S. was so highly leveraged was because of the high rate as well, no?
Absolutely.
So because the groups, it made more sense for them to situate or to put debt in a 37% tax rate economy than in a 20% tax rate economy.
Right, and I think David is suggesting with our states that there would be an incremental 2%, so 35 plus 2. That is why everybody was always putting debt in the U.S., especially in related party contexts, right? They would try to put debt in the U.S. at a 35, 37, 40% tax rate, right? And let the income get picked up in a lower tax jurisdiction. And the more sophisticated companies were using Ireland or Barbados, Switzerland, Luxembourg to get really that 35, 40% arbitrage and not paying tax anywhere in the world. That's gonna crash right now. That has to get changed.
Okay.
Again, the definition of this was a Tax Cut and Jobs Act. Congress was very, very serious about the Jobs Act piece. We talked about the foreign-derived intangible income as a key source of jobs, where it's going to be promoting manufacturing and exports from the U.S., U.S. intangible ownership, U.S. research and development. This is another key provision which under the scoring is supposed to really promote U.S. jobs. And it's the full expensing of capital assets. What that means is if you purchase a building, purchase a capital asset, I don't care how much, how expensive, you can deduct it in year one, okay? Immediately expensing whatever asset you want to buy. Well, what's going to happen now is if I get a big deduction, I'm going to spend more, right? Now, there's an offset with the financing because Americans love debt, right? But we're not going to be able to borrow as much debt, but at the same time being pushed to buy more property. So there is going to be an interesting dilemma that treasurers and corporate executives are going to have to compute here. But this is designed to get manufacturing jobs back in America. This full expensing is for, effectively, U.S. workers to go back to work, okay? I mentioned an earlier provision that I called BEATS, which is the base erosion. If I purchase these same goods from a foreign-related person, I have to pay a 10% minimum tax each year on the depreciation. I don't get the immediate expensing. If I instead manufacture that good myself in the U.S., or if I buy it from an unrelated party in the U.S., I get a much more favorable tax result because I can deduct it immediately. You can see the American First coming strong through here.
Yeah.
NOLs are probably the other big change. Historically, we could carry back NOLs 2 years and for 20 years. That rule still applies for any net operating loss generated before December 31, 2017. Any NOL generated after 1/1/18, okay, in large part probably because of the full expensing rules, can no longer be carried back, can only be carried forward, and you could only use 80% in any 1 year. So again, there is going to be a minimum tax because you will not be able to fully utilize NOLs. So a lot of changes.
Yeah, a lot of changes. And actually, with this, we are ending this part of the session. If there are any questions, we will be happy to answer them. However, we will get into more detail, into more detailed analysis, more granular in the next panels. So if we have any question here, everything was understood, I think.
They're sitting on their hands because it's cold.
Okay, thank you.
Thank you, everybody.